Hey, thanks for welcoming us here to another episode of The Money Puzzle. We appreciate you spending some time with us. I'm Eric Douglas. This is Aaron McAndrew. Of course, this is a production of the Family Wealth Planning Partners team. Here today, the topic for today is going to be, well, we touched on this a little bit before as we talked specifically about insurance advisors, and I think we're going to get into that in a little bit more detail today, but I think we want to talk about how not all advisors are the same, and there's many different types of quote-unquote financial advisors out there, and that's a very broad term, right?
Right. It's a term that sometimes is used loosely, where everybody says, "Well, I've got a financial advisor," or I got an advisor," and what does that mean? So the question that comes up a lot is what does a financial advisor do? Well, there's a lot of different things a financial advisor does, but there's also a lot of different types of financial advisors out there. It's very, very broad title.
It's very, very broad. It's never specific. You know, everybody's got a guy, but not everybody can really very clearly identify what their guy does, so to speak. And so we just wanted to put maybe a little bit of, just a little bit of knowledge behind some of these terms and maybe clarify the differences between some of the types of advisors that you might see or come across out there. Not to say that any one of these types is better than the other, and we'll certainly talk about what we are at the end, but we just want to provide some clarity around the different types of advisors that you will find. So, you know, we started off talking about insurance advisors in a previous video, insurance salesmen, if you will, to some degree, and maybe if you want to elaborate on that, but let's talk about how insurance advisors specifically and what it is that they do and how they might differ from what it is that we do.
So insurance advisors are selling typically life insurance, long-term care insurance, and may even sell fixed annuity products.
Well, we have to talk about whole life too. You got to throw that in there.
Correct. Permanent life insurance, whole life. But a lot of times they'll consider themselves a financial advisor, but they don't have the licenses, they don't have the credentials, really the licenses to actually offer the financial advice. While they can sell insurance products and they can sell those fixed annuity products, they're licensed to do that with a life insurance license. They're not technically a financial advisor. I'm going to give you just another example. I think I may have mentioned this before, is one of the school districts that I worked with received just a generic email from someone that wanted to do a pension review with them. They wanted it got sent out to all of the participants in the retirement plan, and the school district made me aware of it, and it was just, it looked like somebody got a hold of a list, and they sent out and made a large marketing effort to try and get these participants in this retirement plan to come to them for a consultative pension review. Come to find out, we looked up who the person was, and the person's not even a licensed financial advisor, although in his title and his email, on the signature line of his email, was financial advisor. And it was really to look at their pension, to look at what their retirement options are, and his goal was to basically roll that into a insurance product.
Well, typically one of the common things that you're going to see with an insurance advisor or insurance salesman is they might use planning or the idea of financial advising as a way to, I don't want to say lure, because that has such a negative connotation, right? But they're almost using that as a way to get in and provide their solution, right? And their solution is typically going to look like some type of or some variety of insurance products out there, whether that's a whole life policy, and those are usually sold, they're sold far too often, unfortunately, but they're usually sold as a way to build cash value life insurance policy that can come out. You can take loans against it tax-free in retirement, and that's the way that those are often oversold. Typically, going back to your point about variable annuities or fixed annuities or other types of annuity products, which we're not saying at all that those are necessarily good or bad. I mean, we're indifferent about the products themselves. It's just the way that they're being sold and who's doing the selling. Because if you're selling those products under the guise of being a financial advisor, you're not a true financial advisor. If you're not able to do stocks, if you're not able to do individual bonds or mutual funds or ETFs, manage investments, you're not a true financial advisor. If you're only licensed, if you have life insurance, life insurance certificates, you're only able to do different types of life insurance policies.
Or really even provide financial advice. So
you're not qualified at all to provide financial advice.
Correct.
If you don't have the correct, certifications. And typically, once again, these insurance advisors are typically going to be paid on commissions, right? They're not usually working on fees. They also are not held to that what's that F word, right? Fiduciary standard. They're not held to the fiduciary standard where they're obligated to act in the best interests of their clients.
That's a good segue into another type that's on our list here today is a fiduciary. So there are certain advisors that are held to a fiduciary standard. Those advisors provide advice for a fee, and the fee basically takes the bias out of offering different types of investment products that would pay a front-end commission or a trail commission or something on along those lines. So, for example, fiduciary advisor, like Eric just mentioned, has the obligation to act in the best interest of their client and not in the best interest of the firm or not in the best interest of themselves. They are being paid a fee for unbiased advice. So it doesn't matter whether they put them in a certain fund company or a certain ETF or whatever the investment is, they're getting paid a fee on that, and the investment company that they're using is not paying them a commission for those transactions. So there are advisors that are fiduciary advisors. That's a good question to ask if you're looking for a financial advisor, is if they're a fiduciary, because that's important when it comes to what your best
I would
interest
even add
is.
the additional clarifying qualification is it's one thing to say, are you acting in the capacity of a fiduciary? Because everyone's going to say, yes, of course, I'm putting your best interest first. But that's far different than saying, are you required to act in the capacity of a fiduciary? And if you're holding a Series 65 or a Series 66 license or a CFP license, you are legally obligated to act as a fiduciary at all times. It's not just something that we can say we're legally required to act that way, and something that we could, in theory, get in trouble for if we did not ever act in that capacity, which of course we always certainly aim to do. I want to switch a little bit to financial advisors themselves, because there's different types of financial advisors as it pertains to investments, right? And so I wanted to talk about the idea of the type of advisor you might find that's really more of an investment manager or a money manager, basically, 6 of one, half dozen of the other, right? But someone who talks to you about strictly managing your money. They're not really talking to you about financial advice or financial planning. They're not really talking to you about suitability or anything like that. They're really talking to you much more specifically around, this is how we manage money. These are the models that we build. This is, these are the investments that we use. They're very, 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 very focused on investments specifically. They're typically going to fall in line, or much more specifically, in line with being an investment manager or a money manager specifically. Meaning they're managing for returns. Once again, nothing wrong with that. And a lot of them do a really good job. Some don't, but a lot do, right? But they're managing for a return. Their goal isn't necessarily to provide you the best advice. Their goal is to manage money and try to get the highest return that they possibly can.
They're not going to, that's like Eric said, that is their main focus is the asset that they're managing, the accounts that they're managing. They basically are gathering the assets into the different types of accounts, and they focus on those assets that are in there. A lot of the conversations are going to be based off of return, but they're not going to necessarily focus on when do you need to use that money? How do you use that money? They're not going to help really focus on, your other accounts that they don't have. So, for example, if you're still working and you've got a 401k out there at your company, and you have this IRA or a Roth IRA or a brokerage account with this advisor, usually they're not focused on any accounts that you have out there elsewhere. They're not focusing on the planning piece of it either. It's just the assets that they're managing.
How would you describe someone who is a captive advisor?
Okay, that's a great question. It's another example too. A captive advisor is someone who, an advisor that works for a company that they can only offer the products that are proprietary to that company. There's several companies out there that are that way. We won't mention any of those, but if you're a captive advisor, you have to use that company's product.
And typically we're talking about the biggest national brands in the industry. Those are typically going to be the ones that would most likely fall under the guise of being a captive advisor. So if I work for X major company and I'm offering you solutions, it's reasonable to expect that most of the solutions that I would be offering you are going to look like my company's products that they have available. Because if you're a captive advisor, you once again, it's the name kind of implies what it means, right? You're captive to utilizing only that specific company's products, whether or not they're the best, best in the market.
Yeah, it may be the best that advisor has access to, but it's not necessarily the best in the market. It's just limited to what that company has.
Absolutely. So that's another thing to be aware of, and that's a question to ask when you are sourcing or searching for a different financial advisor.
An independent advisor is different than that. So an independent advisor actually is a financial advisor that's not captive to one company, that has access to multiple companies and multiple products, and can then choose and compare those products to find what's the best fit for the client.
Mm-hmm. No, absolutely. Asset gatherers. And I don't know how many people that are not in our industry would totally understand exactly what this means, but how would you define an advisor who is acting in the capacity of being an asset gatherer?
An asset gatherer is basically an advisor that is just trying to do exactly what that term says, is gather as many assets as they can underneath their umbrella. It's not necessarily piecing them together in a plan. It's just, hey, you've got brokerage account here, let's gather as many assets in your brokerage account as we can. You got a Roth IRA, let's gather as many assets here. You got a pre-tax account or a 401k, you want to do a rollover, and we're going to put it into a traditional IRA. And they're gathering a bunch of assets, but there's not a lot of planning. They may be doing money management, or maybe outsourcing the money management or whatnot. And you may come to them if you need a distribution, or you need something, you have a question about particular with that account, you may come to them, but there's usually not a additional planning or anything that goes along. And they're thinking mainly of the assets that they have, and they're just trying to gather more assets in those accounts.
I have found that there's two specific ways to understand if you are working with an asset gatherer specifically. Number one is they're working almost in a sales capacity. So you start working with an asset gatherer, you open your accounts, you move your accounts over, whatever the case may be, and then you kind of start working with someone else, maybe on the account management side, or someone who's servicing your accounts. You're not necessarily working really full time with the original advisor that you started the relationship with. Now that you've kind of been brought on, you've been, for lack of a better term, you've been sold, right? But once you've been brought on board, you start working with an account manager while the asset gatherer is still out there doing their thing, bringing in more business to the firm. Mm-hmm. That's usually one sign that you're working with an asset gatherer. Another is, and this is going to take a little bit more detective work, because you'll want to understand kind of the nuts and bolts of the fees that they're charging. But you alluded to this earlier. There might be an asset gatherer, and then they're hiring a money manager to help work on your account. So the money manager is in fact actually doing all of the investment management piece, while the asset gatherer is not focused on the investment side. They're not looking at your investments. They're not really consulting. They're not making decisions around the types of funds and that you own within your portfolio, because they're far more focused on bringing in new assets to the firm. Someone else is going to actually do the management. Those are the two that I think off the top of my head are usually the two most obvious signs that you're working with an asset gatherer. I don't know if you have anything to add to that.
No, those are good. Yep.
Planners.
Yep. Financial advisor that focuses on planning first is doing bits and pieces of a lot of that. So they still want to gather assets, because you want to put all the assets there as part of your plan. The difference in financial planners and the rest of the one that we've discussed is financial planners are planning centric. So they take your plan, your entire plan. So whether you're in accumulation phase, whether you're getting ready to develop an income strategy, whether it's an estate part of your plan, whether you're passing the money, who you're going to pass the money to, they look at your will, they look at, all of that, detailing it all together. Even if you're working and you've got a 401k plan out there and it's not with them, the financial planner is talking to you about that 401k. It's part of your plan. If you've got a life insurance policy, long-term care insurance policy, they look at and review home and auto policies. Anything in your financial world, they're helping to piece together. They're putting together the different pieces of your puzzle to make your financial plan. And then they look at this ongoing, they review with you ongoing based on things that have changed. Maybe my retirement date, my goal, I want to try to maybe retire 2 years earlier. And these are scenarios you're running by a financial planner, and they're running those scenarios in the financial plan and giving you feedback on whether that's possible or not. And if it is possible, what do we need to change? If it's not possible yet, what do we have to change to make it possible? So they're running those scenarios by you. There's somebody that you can be talking to about what's the best time for me to turn my Social Security on? If you have pension income or anything like that, at what age is the best time to maximize that? Or what are my pension options that I would look at? They're developing an income strategy for you. How am I going to get paid in retirement now when I'm not getting paid by my employer anymore? They're looking at tax strategies. They're looking at the ramifications that you may have on required minimum distributions when it gets to that point. If you have a whole bunch of pre-tax money built up into a 401k or an IRA. These are all just very few examples of what planners take into consideration.
Well, and that's very specific, absolutely. And obviously, as you can tell, if you look at our name, right, we've got planning in our name specifically because that is what we do. We are planning centric, we are planning focused, and we don't make investment decisions or recommendations without running through a plan. Everything that we do, the recommendations come from the planning that we do ahead of time. So it's very important to understand. That's why we put it front and center in our name. You got the logo on your shirt, right? I don't have that. I don't have that on mine. I got a generic shirt on, right? But that's where our focus is always lies, is in the planning that we do with our clients. First and foremost, to determine from a fiduciary standpoint, right? Going back to that F word, what is the most what is in your best interest? What is the best thing that we can do in your interest to provide the best solution for your overall portfolio or for whatever goals and objectives that you have, whether that's for retirement, financial independence, however you want to phrase it, whatever those short-term goals are, we're trying to mirror those with your long-term goals. So ultimately you're able to achieve them all together. We have to plan for those goals. We have to understand what they are. I'll even add, we don't have this on our list here, but I'll even add this additional topic too from a behavioral standpoint. So much of what we do is behavioral and understanding what it is that you're looking to accomplish and really keeping you on track. That's why we talk about planning. Right. It's an ongoing concept. We don't just do a plan, slap you on your butt, say thanks for coming, and here you go, right? See you next year. It's planning. It's always ongoing. It's always constantly changing because your goals are going to change. The way you feel about the markets is going to change. And so it's always important for us to understand from a behavioral standpoint, we almost want to know you better than you know yourself, right? And understand your thoughts about money, how you feel about money, how you feel about risk. Because these are all different variables within your plan that we need to make sure that we're accounting for.
To piggyback a little bit on what you just mentioned there too, we were talking a little bit about behavioral. Like, let's take for example when the markets are down 20 or 30%, and somebody sees their account down 20 or 30%, or they see it down 15%. If they're a moderate risk tolerance investor, or their plan is calling for moderate risk tolerance, the conversation shifts away from what my return is on my account versus what the probability of success of my financial plan is when you have bad market conditions. The plan dictates the investments that are held inside of there. We're not wanting to take on more risk or any more risk than what we need to in order to make the plan successful.
Or I'll even add what you're comfortable with as well. Because if we're doing kind of a behavioral analysis on you and we understand and we talk to you about your level of risk comfort, how would you feel about a 20% loss in the markets? Is that just complete, anathema to you? Is that something that you just know that you can't stand? Okay, well, we don't want to construct your portfolios in a way that they're going to drop 20%.
Right.
Now, they may not grow as fast as they would in a bull market, so to speak, but we want to avoid the downside because we know that that's what's important to you. If you're someone who can take on a little bit more risk, okay, we're going to construct your portfolio in a little bit different manner. And so once again, going back to the name of our show, right, the money puzzle, these are all different pieces of your puzzle that we have to construct, that we have to put together so we can have a clear, concise picture of the goals that you're looking to achieve and how best to, put the roadmap together for you to achieve them. Anything to add?
Don't have anything else. I think that we covered most of that, and so that's,
Yeah, so I think we'll wrap up there. Once again, thanks for joining us today. Now, if anything that we said you enjoy or you think any of your friends and family could certainly benefit from any of the things that we're talking about, we would love for you to share our content. Please like us and give us a subscribe on YouTube as well. You can go to the notes in YouTube or whatever podcast platform that you're listening to our content. You can click the link there if you would like to schedule a risk-off retirement report for yourself. You'll be able to come into our office, sit down with us. If you prefer Zoom, we can certainly do something virtually, and we will construct or start to put the pieces together of your puzzle and start constructing what a risk-off retirement strategy might look like for you. Thanks for listening. See you next time.